Okay, so welcome to everybody at P Confidential, and it's great today that I've got Eric Johnson, who's one of the foremost experts on private equity performance measurement, and we're going to be spending hopefully an hour and maybe more talking about the current private equity market from the point of view of measurement, because if you don't measure it, it's only your opinion, and so measuring is paramount, and this is where Eric really has a wealth of knowledge. So, Eric, welcome to the show. Welcome to P Confidential, and it's what I love being myself a mid-cap run-of-the-mill GP. I'm glad that you were a GP at one point in your career, so I feel a sense of connection. But I'll let you introduce yourself and tell us a little bit more about your background, what you've been doing, and what you're doing right now.
Well, and I guess, Gavin, our LP-GP relationship goes back a long, long time, so I'm glad we've been able to stay in touch from the day when sort of looking at you in the context as a GP ages ago. So my history is centered around Cambridge Associates. I went there, though, after spending a little bit of time as a emerging markets impact investor, but spent over 16 years working with the firm. And I think if you think about the subsequent time I've spent both doing research and then working with a large endowment out in Hawaii, everything I've taken from this is all really from the point of view of the asset owner. And again, I think the point of view of the LP, the owner of the assets, and then how do you think of that from a more academic, but also really practical point of view. And so tried to bring in some of the the academic work, starting really with the financial crisis. And so if you think about at a core this balance, where is the LP-GP relationship, really starting with a lot of that work, trying to see if there might be a way to help reset some of that so it's on a maybe more equal foundation. If you think about
that's interesting. Well, I think it's great that you certainly, as you mentioned, you were investigating me quite a few years ago, and I don't know if I got away with something.
You're still here.
I'm still here. Yes, still trying to misrepresent to LPs during my fundraisings. Just joking. But I think the fact you've been a GP probably is kind of interesting, because so many people in the industry have only been GPs or only been LPs their whole careers. But certainly, the wider the perspective you get, the better. So let's move on to the first topic today, which is we're going to sort of have a general discussion of where the market stands today. What's been going on. Probably the most topical thing to talk about is the paper by Ludovic Filippo, but perhaps tell us a little bit about after these many years of data, where does it stand now? What we know now about private equity performance? How do things stand at the moment?
Well, I mean, I think there's both good and bad news, right? And I think if you read the papers, and again, I certainly defer to a lot of the academics as being far more knowledgeable about all of the technical things, but we're in just such a better place than 10, 20 years ago. You think when the endowment model was first popularized, at least, there was much less history, but fundamentally we still have unknowns. And the question is, from the much larger samples and the much larger amount of knowledge of understanding of the mathematics, what can we conclude? And you gotta, I think, step back to what are we trying to understand here? And from a point of view of an asset owner, you start essentially with this idea of strategic asset allocation, or some sort of portfolio construction that you're going to have that's going to include all the different assets that are available. And in that context, we're still on a very uneven playing field. And so if you think about, sort of the triumph of the optimist, and the history of asset class returns over 100 years between cash, stock, bonds in United States markets and in developed markets, what we have in private equity is just totally not comparable to that. We have a very small window of time in which these assets have really been available on an institutional basis. And we have an even shorter period of time when they've been available at scale and in the kinds of volume that we've seen over the last, let's say, 20 years. And so that 20 years is a very specific time period, and yet you have to really cut out the most recent 5-7 years still as being too early to tell. And so that leaves you in the middle with what is a much shorter time period than maybe a lot of people think. And yet there's a tendency, I think, in the academic world maybe to try to get as far back as possible. And so you look at this and you say, let's take the returns from 1980s onward and compile the total return. And I think, unfortunately, that may be misleading in a way in terms of thinking about the future in a very different way than might be of trying to get the longest time histories that you could for stocks, bonds, and cash.
So what you're saying is, I mean, a lot of people sort of look back 10 years in practice, right? Saying, well, 10 years is like an economic cycle and so it sort of smooths over and we should be looking back 10 years. Other people say if we look at emerging markets, we should look back only, say, 5 years, for example, because the country's changing more quickly than a developed country. So what you're saying is that if we look back too far, it's both because the circumstances of the country are different, which makes it less relevant, but it's also the fact that the quality of the data going back too far is not good enough for it to be included. Is that sort of the thinking about it?
Yeah, so I mean, you think about the professor's paper, and I think one of the reasons we're focusing on that now is just that we have a much richer data set, a much richer sort of underlying history. So it's not just the data, but it's the underlying reality. We have a lot more managers, a lot more funds that have been raised in the United States, and they've been raised in a wide range of strategies. And that's a totally different situation than, for example, where I spent some time in Russia. And if you look at, what is the long-term return in Russia, or what is the, quote, long-term return in Africa, for example, where I helped build out the first benchmark, it winds up being much more dependent on a very specific number of firms that were actually active, and then it becomes dependent on what proportion of those funds that were active did you actually capture. But even if you had 100% capture, which usually you don't get if you're Burgess or Cambridge or really anybody, that's actually okay, as long as it is somewhat representative of a large enough sample. But if the sample itself is very small and is skewed by 3 funds that are 5 times larger than everybody else in the market, it's going to matter a lot how you capture those and how you measure them. And even if you did that, you're still going to have limited conclusions that you might be able to draw compared to what you can draw from example, in the United States. And so, if you look at this history, for example, going back, early, 80s through, through the recent period, you can really make a case that a bunch of these funds, although they have pretty good returns, multiples of capital for the broad group of North American private equity, venture, growth equity funds, similar to the ones that were used in the paper, with Professor Philippou. A lot of that result is real, obviously, but does that tell you anything about what the sort of the standard assumption should be for asset allocation now going forward? Similarly, you can look at the returns, say, from 2014, 2015, some cutoff date, and there's just way too much of that which is still distributed. It is still not distributed. So you have NAV values that may or may not be accurate. You have things that just haven't actually happened yet, and you can draw some conclusions from that, but it doesn't necessarily help give you the answer. A lot of that is just too early to tell. And in the end, you wind up with this piece that's sort of in the middle. And that, surprisingly enough, is really, maybe 20 years. And that's really the period that was focused on in Philippou's paper. He sort of, 1996 through 2015, cuts out the last vintages, but it also omits some of the earlier, 1990s funds, some of which did just extraordinarily well. Why? Because they also caught the timing of the dot-com and were able to exit prior to everything falling apart. Again, that is probably a one-time phenomenon, or maybe it repeats every 10 or 20 years. Maybe we might see that in the near future, but that's not necessarily something that is thing you can bank on. If you're trying to figure out what the returns might be and try to think of a premium that you might be able to put into your model, it's just a very different thing than the equity risk premium of equities versus bonds or cash.
Yeah, absolutely. I mean, but even that period, it's noticeable that Filippo's conclusions about returns seem quite different from the claims made by some of these large buyout firms, such as Apollo KKR and others. And I think that was kind of quite an interesting little bit of controversy when his paper first came out. So I suppose a manager, his job is to market himself. So you can't really blame them for putting themselves in the best possible light. But I mean, certainly reading Filippo's paper as a layman, as a relative layman, and reading the kind of statements put out by the mega funds, I would certainly be more leaning towards Filippo. I mean, what was your take on all that? Because I was in contact with Ludovic recently, and he had a nice photo of himself or video of himself with a backdrop of the Pyrenees, and I asked him if he was in witness protection out there.
Well, I don't know if people have picked up on the fact that I'm sort of mentioned in the acknowledgments right up front for that, and I did some work with him, sort of especially to try to bring in Cambridge data to add that. So I have to acknowledge, by way of disclosure, that I have a bit of involvement in the thing, and so I hope after this is done and you publish it, I don't have to go into witness disclosure too. So far, people haven't made as much of a connection of that as they might. But I think it's an important paper, and I think, I think Ludo's been extremely important in the industry. Actually informed a lot of things that I thought and did while I was at Cambridge Associates from the period of the sort of the GFC onward. Sort of looking back and seeing, here are some questions with IRRs. Here are things related to this really popular exhibit that you see sometimes that talks about the dispersion of returns by asset class, and it has these very narrow little bands around stocks, bonds, cash managers, et cetera, et cetera. And then you get these really wide bands around private equity and venture. And a long time ago, he really debunked that, said, hey, this is just a mathematical artifact. We've talked a lot, and his papers talk a lot about the IRR reinvestment assumption. Well, by definition, if you have a high-performing manager with then assumed that the reinvestment is large, you're going to have a wider dispersion because you've essentially said, the rest of it is assumed to be wide. So those numbers are, really not meaning what they think. Clearly, there's a wide dispersion, but I think you have to do that in a different fashion. So the question of the witness protection it's a good joke, but one of the things that troubles me a lot in the industry is the degree to which this winds up being personalized, right?
Yeah, I think so, because what struck me was that an academic puts out a paper which he's got no axe to grind. I mean, he's just following the science, whereas the managers are marketing their funds. And so, I carefully read, the responses by the various firms to his paper, and they were, there was this personalized kind of attack tone, but no real arguments except, accusations of it being misleading, but there was nothing there. Right. I even saw the guy, the head of Invest Europe, wrote something, but, not substantiated, sort of fact-free assertions, which was kind of...
Yeah, and you'll see if you dig around on my LinkedIn feed, you'll see I responded to some of that as well, and I guess the AIC, but it goes to the academics also, and it goes to the the LPs, it goes to the trustees, it goes to the people that, again, he pointed out have a vested interest in this. It's not just the fund managers. And again, you can argue about whether that's the biggest impact or the biggest thing that's important, but I think a lot of people have talked about the more sensational things, and again, I think it was a good approach from a sort of a getting the message out point to sort of bring out some of these things in very tangible dollar amounts, specific firms. But obviously, it would be crazy if there wasn't a response from that. But what hasn't really come out a lot in the analysis, in the subsequent commentary, I think, is a look at the table.
So we'll put that up on the screen. That's a very, maybe you could explain this table a bit more for some of the viewers. Yeah, so it's like you've broken it down in a more granular level.
Well, a little bit more granular, but you can think of what he talked about in the paper is results in different ways, right? Trying to understand what the results are of actual LPs by getting pension investors and their programs and sort of looking at those, right? And so those are the big pensions. Yeah. What he did was look at the big private equity firms and look at their results, getting very granular, look at individual deals. But what is sort of stuck in here in Table 4 is an update on some work, sort of like what some of the academics have done, and which again I think has been missing a little bit more in terms of the broader discussion. What do we know from the actual manager universes? And this is not something that is promoted by the GPs, not something that's promoted. And this is something, for example, AIC could really do this quite easily. They could get the data from Cambridge and Burgess, and they could put out reports that sort of start at the same point in time and say, okay, let's look at the big databases that are out there. And again, I would really highlight Burgess and Cambridge as being very high quality. I spent a lot of time improving the quality of the Cambridge database, specifically with emerging markets and work that we did starting with the development banks, the IFC, other DFIs back in 2002, 2003. We built out this thing, and it takes a lot of work. You need a lot of effort to get more managers and funds in there. But once you've done it, you then have quite a lot of insight. Burgess has taken a different approach, but is also extremely solid. And if you look at the Burgess data, which again I used a lot when I was in the endowment over the last few years, these numbers are not that different. They're actually fairly similar. The Preqin numbers also, generally similar. You have maybe different transparency there, which is advantageous, but takes a little more time to get the numbers together. But if you look at these, let's start with sort of a decent analysis of these different data sources and get away from this idea that, oh, well, we don't really know anything. Well, we don't really know. If somebody wants Burgess, we really like Burgess data. It's very popular amongst the academics because they can get access to it. Cambridge data, very popular among limited partners, Cambridge clients, but also available through Refinitiv. Has a whole set of insights that you can draw from that. Hasn't been used as much, but it has been at times reviewed rather systematically compared to these other data sources, and shown that we're relatively similar. We have a pretty good idea of literally trillions of dollars that have been invested.
Okay, so that's great. So that means that so it means that the data is pretty solid. And I'm looking at this table called Expanding Ludo by 5 years. So getting on to maybe some of the conclusions based on this data. So this expanding Ludo by 5 years, it sounds interesting. I think a lot of people are interested to know what this is about. So you're sort of extrapolating. What does this tell us? This table here that we're going to be seeing on screen.
Well, so you use the word extrapolating, but it isn't actually extrapolating. This is literally going into the same data source from Cambridge Associates, which is shown in the last couple columns of Ludo's paper. In working with him, I provided him a lot more than just, I guess it's 8 digits, or not 8 digits, but 8 numbers that he was able to fit into this table that cover different time periods, cover sort of more granularity in terms of the underlying returns. But what this does is it takes not the 10-year period that he focused on and not the previous 10-year period, but it also just moves back the measurement period. So we have a 15-year of most recent history. So this is 15
and the
years.
And the conclusion's the same.
The conclusions are pretty similar, right? And so this is a PME-based analysis. PMEs of 1 are above, and that's outperformance. But I've use PME some, but from the point of view of LP and in my consulting work, the way I think a lot of my colleagues also have thought about it. We like to think it's 1.0 and 1.01 are very, very similar. They don't really matter. You really need to have sort of a 3 to 5 percentage points outperformance of some sort. You need to have outperformance that's sort of meaningful, and a lot of the academic and I think discussion sort of gets lost on that. You say, oh, well, we outperformed, and then you look at it and say, well, we outperformed, but it's like 1.0 or 1.2%, and that's like, okay, that's sort of not enough that I think most of my old clients would have wanted to invest, and that's too close to the thing. And what here you have is these PME numbers, that especially for mid-cap stocks, small-cap stocks, sort of an equal weighted mix of the S&P. So we know S&P 500, we know Russell 3000. Returns are heavily dominated by the mega cap stocks at the top. It's not just that they're in the index, but they also have a much greater weight. And so if they have a great big weight, then measuring your private investment portfolio versus that, as Ludovic, others have shown, it has some problems, right? Although, I mean, there may be times when you also want to be keeping that in mind. Say that the market cap weighted big stocks are really, 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 really cheap. Okay, would you want to do private investments if you could really get, broad, cheap, high quality companies that would actually do as well or even better? So,
yeah, I think what you're describing is, from the point of view of a GP, it's a bit like an existential threat, because what this data is saying is that a kind of GP with all his supposed skills is on average not performing any different from just some guy in front of a screen just tracking the index with the lowest possible overhead. So I guess you can understand the GP's reaction. And if I'm a GP and that's the reality, all I got left beyond that is to say, well, I'm a top quartile guy, not a bottom quartile guy, because that's all I got left. Because if on average it's the same as the index, I've got to be a top quartile guy. And as you know, Eric, you go to a private equity conference, you'll never meet a guy at the coffee break who says he's a bottom quartile guy. They never seem to exist. I don't know if they didn't have the money to pay for the conference, but they never seem to be there. They must exist.
Well, and it's a fair comment too, because unless you are an LP or you're Cambridge or Burgess or something, a GP literally can shop to become a better quartile ranking. So how is the quartile, what are you ranking? Are you ranking the IRR? Are you ranking the the multiple of capital? Are you ranking a PME based thing of some sort outperforming? All of those give different universe, a lot of it overlapping, but different universe. Which methodology are you using for your vintage year? And if you are using the standard Cambridge thing, you would use a vintage year based on fund inception, but you can also do it based on the year of the first cash flow. And if you don't like Cambridge, you can go over to Burgess, or you can go to one of the others. And literally, the studies I think in the past, they were sort of 60 to 75%, could legitimately claim that they were a top quartile in one way or the other. So unless you're sort of imposing discipline on it from the point of view of a consulting firm or from a internal team, that we will always look at all these managers in the same way, they can do that. And so
yeah, so you end up with a problem of apples and oranges, and the manager kind of shuffling the decks so that he's muddying the waters, so to speak. Well, this is a great cue to move on, maybe to talk a bit about methodology. And I think in your paper, your ILPA paper of 2017, which was an amazing piece of work and subsequent work, we have some of the key concepts which we have to cover when it's a methodology. And I think just to summarize it, it's about the premium, to quoted shares. It's about the method of private PME method, which we'll talk about. It's about allowing for leverage. It's about manager selection, and it's about geography and strategy. So maybe we put a few thoughts on each one individually. So what about premiums? I think you've got some pretty good ideas about premiums. What should the premium be, and how do we derive it? What's your thoughts on that? What's your work? How would you summarize the work you've done on that?
So yeah, thanks for the comments. This ILPA paper, I think may be known to a lot of the ILPA members. It's been on their website for the last few years, but they just announced and they allowed it to be released earlier this year, so it could be included in academic work, and Ludovic cited it in his.
I think it would be fascinating to give it to a wider audience, because most of my GP friends in Europe, they hadn't a clue about this paper, and then half of them don't even know what ILPA stands for. So it's pretty sad.
Yeah, well, ILPA is a great organization. It really has the right sort of institutional position, I think, in the ecosystem to potentially pick up on these sorts of things and take it more broadly. It's one of the reasons that I wanted to work with them on this paper back in 2017. Sort of turned it into a presentation masterclass that I did at their 2018 annual meeting for 90 minutes each. That went through this in some detail, but they were able to survey their members, and we were able to go with help from Cambridge Associates and survey their endowments. Again, most of these institutions were looking to get sort of a 300 basis point premium or more versus some index. I mean, again, a question could be it's different depending which index you're using.
So great. So tell me, what are the main concepts that go in? I mean, we don't need to go into details of calculations, and I'll put some information up on the screen. But what are the main thought processes or components that go into building up the premium? What are the key components that you have to consider?
Well, I mean, I think that each institution is probably going to do it somewhat differently. And again, it gets back at this problem, which I think you've talked about in previous episodes, and is out about risk adjusted is very difficult here, right? I mean, the whole idea, for example, is that you have widely recognized some degree of illiquidity premium, which in theory should exist. You should in fact get paid for. Not clear that you necessarily do get paid just by going into this. That's, I think, a huge open question. But illiquidity and an liquidity premium, if you think about it more broadly across other asset classes, it's really designed as a concept for how much extra premium would you have for otherwise identical assets. So, a 29-year bond versus a 30-year bond, some degree of difference in how you could actually exit that. And of course, that's totally different than what you have in private investments, right? So even if we take, for example, that we're going to do a PME type analysis against, small cap stocks or small cap value stocks, and maybe we would lever it in some point, you're still talking about a lot of what I like to refer to as private investment risks. You're taking a blind pool of assets on faith with a GP who may or may not know what they're going to invest in. Most likely they don't. You're taking a lot of sort of agency risks in working with them. You yourself are probably going to be in a much lower quality quality of companies than the typical small cap index might be. And there's all of these different. Please leave a message after. And there's all of these different things that come up. That the so the risks that you have. Again, you have reduced legal rights potentially versus being in stocks. You have agency risks. You might have all of these things of working with a general partner in an unknown environment. And one of the risks, again, is that your partner may blow up, right? So even if you have good incentive structure, 5 to 8 years from now, you may not have the people managing it that you thought you were going to have, right? And that's very different than if, for example, you could just get an option to buy, and let's say an emerging market stock index, but you can't get that paid off except for 5 years. But at least at the end of 5 years, that you're going to get this bunch of securities. That they actually exist. You just have a very different underlying mix, and so the premium is a mix of those things, right? You should. So
it seems like to summarize it in buckets, it's like it's the illiquidity, it's the quality of the companies themselves that are sort of lower quality, and it's the risk of the manager risk as well. So sort of three buckets. Would that?
Right, and there's a degree as well, right, that you are making a single irreversible decision now. So it's not just it's illiquid, but you got to make the decision now, and if you're wrong, you got to live with it. It's the proverbial marriage where, yes, there's a secondary market, but very often If the things are going badly, then that may be the time that the secondaries are discounting a lot more than when things are really, really wonderful.
Yeah, because I know there's been a lot of talk about secondaries market, and secondaries players are doing a lot of promotional webinars. But it seems to me, I mean, at least from the research I did, that the annual volume of the secondaries market is something like $80 billion a year, which is really a tiny percentage of the whole overall P market. So it seems to be quite significantly overblown. I don't know what you think about that.
Well, it's also, I think, more importantly even, it's when that liquidity would be there, right? So if it's exactly at the time when everybody else wants to get out, then that's not going to work so well. On the other hand, I think one of the things that is positive, certainly, if you think about these big booms and over optimism, I think one of the problems, in this period running up through the end of the year, you had these very, very illiquid assets, and you also had very, very high stock market valuations, particularly in technology. So if you actually had taken illiquidity risk, but for a point of view of wanting to rebalance or take some of your cards off the table, the cost of that illiquidity was somewhat lower because the secondary market is sort of good when everybody else is optimistic. You could potentially get out and sell some technology exposure, sell some, sort of things that have really done really well when everybody else is still at the party, drinking the Kool-Aid. But it doesn't work so well once, the bubble has burst, or once.
It's a good point. It's a good point. There's a chart which I find very fascinating called US Direct Alpha by asset class. And I think a lot of people, particularly not completely expert, are going to be very interested in the fact that the chart seems to suggest that there's quite a difference in performance between the types of funds, because we've been talking in general about the asset class, and here it's sort of broken between mega funds and mid-cap funds. What do you think this chart tells us? I mean, I think it's something that's quite interesting for people to look at, because clearly when we're looking at the private equity asset class, it consists of lots of stuff, mega buyouts, mid-size, venture. So what does this chart tell us? Maybe summarize a few, what the sort of conclusions are here.
Yeah, so I think what it does is it sort of goes a little deeper than what's in the paper, for example, that Ludovic put out. You have this problem of lumping and splitting, as the.
Because I mean, I must say, I personally love this chart because I'm a growth guy. I'm a mid-cap growth guy, and I see 1.78. So I'm over the moon.
Well, so the problem again, even in some of the responses, since Felipeau's paper came out, is you have people again. They're just talking past each other, and I think one of the first things that the industry really needs to do more is sit down and say, okay, for example, we've got these. 3 databases, we've got these aggregate numbers in the table 4. Let's see, okay, how do you explain this? What do you explain? And so one of the things that you would do is you would look and you'd say, okay, let's break out the different things that have been lumped in here. Let's do what, in a other asset class or a broad multi-asset class, it would be like attribution analysis. And so here you can see that the mega buyouts over this whole 20-year period in the U.S., again, have 1.1 return, but they also are a much bigger portion of the capital. So the size of these bubbles is related to how much was committed. And small cap buyouts, which have been the rage recently, have certainly done better, and they've done even better over certain time periods within this. There's an aggregate number. They're much smaller. So you can't jam all of the money into the thing. Even if you had foresight ahead of time, you wouldn't have been able to put all it there. And you have these other things which historically were part of private equity, as Cambridge would define it. Was private equity energy. They've since over the last year pulled that out into a separate category, partially because more and more managers like a separate area. But if you were doing your analysis ahead of time, based on this is how we think the universe is together, you would have had buyouts, growth equity, private equity energy, and mezzanine funds all together in a bucket. Well, buyouts have done better, but on a going-in basis, you would have been putting these other things in, and when you look at all that together, again, you get a worse result. And so if you want to look at the table 4, for example, it's a very broad universe, and it actually also includes real estate and infrastructure funds. The real estate hasn't done as well. So okay, let's talk about that. Let's peel that out, and then you start looking at other ways to sort of segment the timing. But instead what you get is somebody says, oh, this paper is really difficult, it doesn't really do the thing, and then they go and they measure something totally different over a different time period and say, but my analysis shows these things are great. And then
so it's sort of apples and oranges, and everybody kind of obfuscating.
Apples, oranges, and mangoes, tangerines, and kiwi fruit. I mean, it's like literally geographical mix, all these different things.
Yeah.
And it winds up where you can just you sort of just put anything together and say, this shows something else. And until we actually sit down and be a lot more systematic and disciplined, again, you're still going to get these things. This comes out in the AIC sort of paper on the pension funds and the endowments they put out, shows, here are these institutions, they did really well. Well, how do you define well? Well, they have a 16% return or a 15 or 14. Well, you don't know what went into that. Some of them might have been investing in Israel, or some of them all putting their money into venture capital at a time when venture did really well. You need to sort of dive into the underlying pieces of all of these different things, and it includes geography as well as the strategy. It includes the vintage years that are included. But again, do you put in vintages from the 1980s and run up the returns? Say, that's the longest history we have. Let's say that we've got a very big margin based upon long-term history, or do you look at this more recent 10-year period, the 15-year period, the 20-year period, and say, it's okay, but it's not great. It ain't.
So let's now talk a bit about PME. Now, I think you were one of the creators of the Cambridge Associates mPME method, which is clearly one of the a major achievement in terms of being one of the founders of the market. So obviously, for those of you who don't know anything about PME, what it does is it compares the private equity investment to a comparable quoted stock, and clearly the part of our discussions have been what is comparable. But where do we stand on the science of PME today? Is it quite robust? And is PME the premier or the only way to really get a sense of private equity returns? Where do we stand today on the science of PME? or should we call it an art? I don't know if it's a science or an art.
No. Well, it's a mix of both, right? But when you say science, I mean, some of this is like elementary or middle school math or something. Some of it's not particularly complicated, certainly as a concept, although in the end we often wind up using either an IRR. But in the simplest format, this is another one of the problems, right? You have people saying, well, I want to do this math, I want to use this math, I want to use this other one's no good. And so one of the things that we tried to do is make available not only the Cambridge Associates math, but for all of the Cambridge clients, for all the ILPA members who draw upon Cambridge data, for all the people who can go out and hire this through Refinitiv, you can do the Cambridge mPME, you can use the KNS PME, or you can use Direct Alpha, which is essentially closely tied to that. All of it right in the Cambridge tool. And so it gives you very similar, sort of results, very similar conclusions. And there's some of that in the 2017 paper with the data up to that point in the appendix. And it leads you towards, sort of similar results. And so, I would maybe, sort of look at this slide you've got here, the stock returns using the PI cash flows and the mPME. This looks at vintage years over, really the whole history of private investments. And what's interesting about this chart...
Which chart is it? The one called... what's the title of the chart? Just so I don't get it wrong when I put it up on the screen. Vintage stock returns using PI cash flows.
It's page 16.
Okay, I got it. Yes. Apologies to my viewers. Okay. Stock return. Okay, so this is basically what this is showing is the mPME method, and it's showing private equity returns against public stocks
let me explain this.
Please, explain, please. Yeah.
So let me explain this exhibit. This is an exhibit that one can use along with private investment returns, but what this solves is actually a different question. First and foremost, this has no private investment returns explicitly on the page. All this is the pile of money that you would have gotten by putting money into the stock market, holding it for some time period, and then selling it, using the cash flows to tell you how much to buy and how long to hold and when to sell. So this uses private investment cash flow as the input to tell you how long to hold this virtual portfolio of stocks, and it gives you a total cash multiple. So,
so it's like, instead of putting all that money into private equity, we pretend we put it into stocks and see the outcome.
Right. And
so the interesting thing about it is that it reflects the amounts of money that go in each year.
Well, yeah. So what's interesting about this is if you take the first number here, the 2.53 next to the red line, that means that if you use the S&P 500 as your index and you invested in that index, money in terms of the timing of private investments, hold periods, and then selling according to when you sold the private investments, you would have gotten a multiple of 2.53. So it gives you a direct dollar value for how much you would have gotten. So this gets around a bunch of the sort of the math problems that come up in the K&S PME, which is a ratio, comes up when the 2.3% of alpha, or at least outperformance, because not really an alpha, in the direct alpha comp. And it just tells you, if I invested $10 million, I would have gotten $25.3 million in stock returns. And so this was really the core problem that I was trying to address back in 2010 when we first started looking into this and realized, how badly the Long Nichols PME, failed at times when you had things like booming stock market or booming private equity markets, and venture, you wound up having to go negative. You maybe had to short things. It wound up being not really sensible. And so, just to understand what pile of money would you have had if you'd been investing in stocks similar to the thing that you already have a total value multiple for. You have a DPI multiple on the private equity side, excuse me. You have that multiple on the private equity side. And so 2.53 can be compared rather directly to the number that you would have in private investments in that same time period. And so that is something which, in that case, the stocks did better. Other years, the private equity did better. But the thing that is really most interesting, and again, this ties back to some of Ludo's work, this average, if you put like 1.55 multiple, despite all of the ups and downs of the stock market, despite all of the annual or sort of rolling 3-5 year volatility, when you are essentially dollar cost averaging in, holding for some time period, and then dollar cost averaging out over multiple time periods, you can take any one of these vintage years as the starting point. You can use the private equity pattern over the next 10 to 12 years, and you get a multiple that's 1.5, 1.6 for all of these different indices, with sort of the exception of the sort of 97, 98 period when you use the S&P 500, where it drops down closer to 1 because that index had such poor performance. We often think about the dot-com bust focusing on technology, venture capital companies, but large cap aggressive large cap growth companies also are very, very expensive, and there's a big bust, and that shows up in the low returns. And again, I think that's where some of this analysis on private investments has gone astray, and I think where the paper that Ludo and others have done are sort of saying, well, let's look at something else, because what we have been thinking, or maybe what some of the early analysis thought was private equity outperformance, is much more just a matter of choosing a benchmark that really did very, very badly during that time period. But if you're at sort of 1.5 as the base, again, I think this has some implications in terms of how the industry ought to be thinking about actual alpha or actual outperformance? Where does the carry kick in? Why as an LP, why as a trustee, why as an asset owner would I want to give 20% of the upside above a 1.0 return if on a regular basis I could get 1.5 return, or maybe sometimes it's 1.4, maybe it's 1.6, just by putting money into the stock market, but sort of averaging in and averaging out over a 10 or 12-year period.
Okay. Okay, fascinating. I see that time is flying. So let's go on to leverage and sector effects. Maybe you can just quickly summarize how we have to allow for leverage and sector exposures in order to fine-tune our methodology here.
Yeah, well, I think again, this is something where I haven't done so much original work, but I think it's quite important. And in the 2017 paper, I highlighted this work that the CPPIB and ADIA, people had done in the previous year. They not only peeled out, the effect of going from the S&P 500 to an S&P 600 small cap stuff, but they also adjusted that for leverage. And you lost, again, about 150 plus basis points when you did that. You ought to, ideally, be aware of what types of companies are actually in the index that you're looking at. And when they adjusted it for the sector, that also dropped somewhat more. Interestingly enough, when AQR did that thing, they cited the same paper. It's been cited, I think, by Ennis. There's some other more recent work, which I think this all sort of points to an additional level that obviously an LP can be doing. I think some people are doing this already, but it doesn't really show up in the broad-based work that is even in the professor's paper. Doesn't show up in a lot of the broad-based analysis that you would want.
So it's a risk factor. Yeah. So it's a risk factor that's missing, and it means we should raise the bar a bit more to allow for this effectively.
Well, at least on the buyouts, but again, not everybody's got leverage, but you've got other things. So obviously, if you're not doing some sort of sector adjustment or thinking for venture, you're really missing a huge part of the boat, right? And so you could do part of that by looking at, technology indices, certainly. But even on private equity, I think the last year's exposure analysis on the underlying companies in the Cambridge the Cambridge buyout and growth equity, I think it was something like 30% of that was technology. So, if you're not looking at the underlying, composition, you may be missing something else, which is actually contributing a big factor to the returns, and yet you're paying as if it doesn't. So,
okay.
How do you think about that?
Interesting. Yeah. Now let's get on to the topic that I'm the most scared of, which is manager selection. And I see a very scary slide saying that without the top 5% guys or 10% guys, the other guys are pretty useless. So basically, it's saying that the top 5 or 10% of fund managers are kind of carrying all the deadbeats, the rest of us.
Well,
is that right?
Well, again, it depends to some degree on what time period you're looking at. Depends on whether you're including the venture, because a lot of this comes out in spades in venture. Certainly comes out in the the 90s when you're including 90s funds onward. But I did this in the ILPA paper for 2017. Tried to adjust and only look at the venture funds after 2000, so eliminate the bubble, and then use private equity or buyout growth funds that started somewhat earlier, would have gone across the bubble, but also cut off prior to the GFC. And I think this is we pay lip service to it. Everybody knows that there's some element of this going on. That's behind the idea that you need to be in the top quartile that we talked about. Maybe you need to be in the top decile in order to get these returns. But there's sort of two ways that you could think about it. One is that you need to do this, and this then creates a lot of potential problems because you have to worry about the access to those, or whether persistence allows you to have better ways of identifying these funds ahead of time. But in theory, the other way that you could try to get around it is just try to avoid all the stuff at the bottom. Try to avoid all the stuff at the bottom that is really, really horrible. And does that actually get you there? And unfortunately, a lot of the time it doesn't. It winds up that if you were to assume that you don't have access to the top quartile managers, but also assume that you really had superior ability to avoid ever making a mistake. And again, by mistake, I don't mean a bad decision, I actually mean a bad result. Because a lot of times you actually make good, decisions at the time, and nevertheless something bad happens, and that manager that really was, by all measures good, actually then winds up in the bottom quartile. But I assume you can avoid all of those. You still wind up losing a lot, just if you are investing in the second and third quartiles.
Yeah. And so basically, the second and the third and fourth quartile are basically sort of toxic, for anybody, right?
Well,
essentially.
We're all gonna have the fourth quartile. I mean, I think that's again part of the the thing everyone who's looking at this for a new allocation needs to think. I mean, it's almost impossible, right, to think that even if you hire the best consultant, you hire the best team that just came out of one of the large endowments, and you give them a lot of resources, it's just very difficult to imagine that you're going to wind up being as competitive as those who are already doing it, and that nevertheless you're going to wind up with some things that just don't turn out well, even if you are doing things really, really well. But the problem is you don't know that you're doing things really, really well on a relative basis. I mean, you need to be thinking about how you stack up versus all the other competitors that are out there. And by competitors, these are the limited partners. These are the other people that are all trying to squeeze their money into the top quartile, the top decile, as they understand it.
Yeah, no, so clearly it's going to be a perennial issue. I think there was a very amusing quote by a book by Josh Lerner saying that manager performance is a bit like a mediocre college where everybody gets an A- as an average grade. So let's go on to the last chart I wanted to trouble you with, and it's like this quite science fiction looking one. It's called Capital Raised by Vintage Year versus Direct Alpha, and you've got these very interesting loops. So perhaps you could you could sort of explain walk us through that, what it means, what lessons we can get from this chart, because it does look very interesting.
Yeah. So the Star Trek logo inverted, or whatever this loops are here. So I included some of this in work that I did with ILPA, but it wasn't really a main focus. But I think it graphically shows something about the relationship between large commitment sizes and better returns, but using this broad group of North American private equity and real estate. And so what's a little interesting, it isn't shown here, is if you looked at this in the past for buyout growth equity, it also looks sort of similar to this, where you had this piece up in the upper left corner where the 05, 6, 7 vintages are very large, right? The 100% is the maximum amount of capital raised, and that's in the 2005 vintage, and everything else is shown proportionate to that. And then the outperformance is shown across the horizontal axis, with 0 being everything to the left of that is an underperforming vintage year. And you see some early years, 95, 96, are very high performance, but also very, very small. And you can just start in that lower right corner and follow the line chronologically. So it goes... It's
very interesting. I mean, it's the challenge is trying to draw conclusions from it. I mean, I guess one of the natural things people might say is if there's less capital being, less supply, there's not such a wall of money chasing the deals, and the valuations may be lower, and if there's more money, it's harder to find the good deals. That would be a kind of intuitive explanation.
Right.
But this doesn't really...
Yeah, that is what it's trying to show in a different fashion. Yeah.
Oh, okay. Okay.
Yeah. And so I think Professor Brown had something on this using Burgess data, but in a sort of a correlated line fashion. This is just taking the total, because I don't have access here in the Cambridge to the underlying funds, but you have the different different year total pooled results, And it shows that those 05, 6, and 7 were the largest years, and they did, sort of worse. But you also have some noise in the middle. And then what's interesting is you have this, 11, 12, 13, 14. Recent history is actually saying, yeah, actually it hasn't hurt us so far. We've had results that are in the 3 to 5% outperformance, even though we're sort of, 50 to 70, 80% of the size. So more recent years have gotten bigger and bigger, and they are still doing okay so far.
That's interesting. Maybe there's a bigger supply of deals or something.
Yeah.
Clearly, there's a study to be made on this. So.
Yeah. So there's more stuff going on, but it's still early, right? So the question is, all of these things are also somewhat affected by the public market return. So this is not just the private investments, but it's also this interaction which has things going on both sides. It has things going on both sides, the private investments as well as the public. But certainly this goes up through 2019, end of the year. I might make another comment. Just all this work was done through the end of the year because I think it's the best period for analysis. It's the steady state, everything's decent, we're all happy. We could, in theory, have just invested in stocks and then sold them, but we didn't because we think we're going to get a nice return out of private investments. By the time you get to Q1, it's chaos again, right? We have now the crisis, and it's going to take some quarters, or even years for all of that to really shake out. But even when it shakes out, that's again one of these extraordinary periods. So, we have this crisis, we had the GFC, we had the dot-com bubble. So one thing is how things, go out through the crisis. The other thing is really how could you have invested otherwise prior to, the dot-com, NASDAQ crashing? How could you have invested when everybody's looking around saying things are really expensive, things are sort of scary? Do I want to be in something where I can get out, or am I stuck in something where I'm along for the ride? And so you'll see some analyses on these longer term results already, I think, come out. March 31st data, we have a big return. Well, it's probably 1.5 percentage points over long-term direct alpha improvement just from that one quarter, because the public stock market crashed through the end of March, but private equity is still very sticky, hasn't moved. Be very, very careful if you're a trustee, if you're getting pitched on how private equity is wonderful, if you're using the Q1 data, or even if you're using Q2 when obviously public markets have bounced back. I would still think there's a lot of value to looking at, again, the numbers in Philippe's paper, the analyses through the end of the year as a representative example of whether this has worked as well as you think it would work. And then, come back to it, again, a year from now, obviously look at the things in the interim, but those interim things are big enough moves that they could actually skew the longer term numbers in ways that aren't necessarily.
I think we're seeing that this year with the COVID, because the NAVs in private equity are released on a quarterly basis, which is not like the stock market, which is a daily price. And so, we saw the Q1 number, the Q1 numbers, the Q2 numbers end of June. It's probably too early to tell. But let's in our last few minutes, let me give a couple of questions that I got from a couple of my channel guys. The first question is about manager persistence. The question is, what's the most common form of movement between quartiles? Is it the top quartile falling down, or is it the bottom quartile going up, or the second going to the third? What's the most common pattern of movement between quartiles in terms of manager persistence or lack of persistence?
Oh my.
It's a tough question, I think.
Yeah, I'm not sure. Yeah, I did a huge, very granular study of this when I was back at Cambridge, which I don't recall, all the details of. Unfortunately, it's for a big pension, which again, really, you have some data problems because again, just getting into the quartiles, you'll have some fund managers that show up and then they drop out for one, and then they come back, and so the academics covered this. I think they do have sort of a fairly random move between sort of 1 to 2 to 3. Sort of if you're in one, you may be again 25% chance of showing up in one again. The one place where I remember the persistence was really quite profound was in sort of venture capital funds, but not the first or second, third funds, but the ones that are sort of like fifth, sixth, generation. So you had cases where that showed up as a much stronger signal, a lot more repetition from first to first or from first to second. So again, if you could see, from first you go to 60%, 70% in the top half, that would be great, right? Because you just want to be above average. You want to avoid the ones that are losers. But I think it still winds up, in aggregate, too often, sort of, if you're in the second, you have, sort of a 25-25, in broader, chance of being distributed across the quartiles in the next generation.
Okay, well, that's a great answer, because it leads me to my final question. So basically, there's not a confirmed pattern of persistence. So this brings me to my last question: is what do you think the chances are in the current market for first-time fund managers? And I suppose if there's no persistence, that logically there should be a better chance for a first-time team. Would that be right?
Somewhat. I mean, I think definitely. We've had over time a lot of sense that, oh gosh, you just are going to have to go with the established big names and the ones who can show all this. There's a distinction again, which I think the consultants have made and the other LPs talk about. There's first-time teams. There's first-time investors. We don't want first-time investors. Maybe it's a first-time team, or maybe it's a team that's a first-time fund, but is actually not a first-time team because they've been doing some stuff together. They've been putting together deals. And so, I've talked, a bunch, with some fund managers. And so I think there's a lot to be said, right, for a good first-time organization, but it does have some more risks than, a sort of a second time. So, if anything, probably the second-time groups might be better at convincing the LP, because they can show that they have made some of the mistakes, they've already learned something, but it's still too early to show that they have a top quartile result. There's 3 to 5 years.
Yeah, I think that's right. I mean, having worked as a consultant, operational consultant to GPs quite a bit in recent years, I think just the fact that after a few years they're still on speaking terms is already quite an achievement.
Right. Yeah,
given human nature.
Yeah. I think one of the people, I forget who it is. First, great question. Have you had your first fight yet? Right. How has it turned out once you really came at odds at something? And tell us about that. There's just a lot of stuff that you learn, obviously, in going through this. But at the same time, certainly there's good data. I mean, Cambridge has shown, in that top quartile, you have a lot of first and second time funds. Every year of the top quartile, there are first and second time funds that are there. The key question is, as an LP, what are your skills in being able to identify those people? How are you going to do better at picking them out? What are your actual true skills, as opposed to maybe your overconfidence, right? I mean, I think this is the biggest area where the Kahneman-Tversky type things come in. Do we as an LP think that we are going to be good at this? Do we think that we're going to be so good at it that we're really fooling ourselves in some way? Do we think that our current status is X and that's good enough? But how do we know? Because we really don't get a lot of insight into how a lot of the other best investors are doing this. We get glimpses of it, but they are probably keeping some of their secret sauce for themselves. And even
so they
if you
should,
do
yes.
Know,
so they should, yes.
Right, and even if you, it's their responsibility in the end. Again, that's why you see a lot of folks sort of clamming up a little bit more about their manager lists or about what they actually do. Although you can get insights to this, but even if you get insights, say you hire somebody who worked there 2 or 3 years ago, those guys aren't holding still, right? So they're also improving, they're also trying to get better, and are you going to succeed in that, or are you going to think that you're succeeding, going back to that slide, but in reality you're playing in a slightly different fish pond? The fish pond that you think you're playing in is the one that shows up in the Cambridge stats, that shows up in Burgess stats. But in fact, you've got sort of little little bays on the side of the fish pond where some of the big guys have sort of walled it off, and the best fish are in there, sort of stuck, and you have no access to them. So in reality, you're going after some other 90% or 80% of the pool of things. And if in fact the data shows that 80% of the managers that are out there are in fact likely to give a 5% premium, then it doesn't matter so much. You can go out and throw your line in, and sort of whatever you pull in on average is going to do well. But if in fact it's 10 or 20, 30% that you need to get, then you better be very good at identifying those. And again, if persistence isn't as strong as people have thought it was, then this emphasis on skills, other things that you need to do, whatever it is, the network, that brings you the new things, as opposed to the network that brings you access to the things that everybody already knows about. Because if persistence is really strong, then it becomes just a huge access game, and those who have embedded positions, those have ways of making.
So it brings us to the proprietary deal, which is the holy grail for so many GPs.
Yeah,
exactly.
So the supposed proprietary deal. I mean, I remember reading one ppm when I was at the endowment. It's like they were, honestly, they said, we'd like to think that we're getting proprietary deals, but we have to actually say that, of our last X number of deals, there were pretty much like 50 to 70 competitors in most of them. Yeah. Oh, okay. Well, that's a lot of people trying to make a deal with this. And so it gets back again to this broader question. How do we think about the asset class returns? I mean, you can, I think, make a very good case that if you're trying to do asset class returns, that should be something that is available to sort of the average investor. The naive investor who goes in and says, I don't really know much about stock picking, I'm not Warren Buffett, but I'd like to get the asset class return for participating in US stocks. Well, that's easy. You buy an index fund and you get everything. You buy the haystack. But here, what is the average return that, again, not a totally naive person would get, but say an institution with just average skills, average resources, because obviously you have to pay something. You can't do this without having lawyers. You can't do this without having done diligence. Otherwise, you're going to get well below the return, almost guaranteed. But say that you have just the average thing, and that's, again, where that second and third quartile, maybe that's more true. I mean, it's like 50 to 60% of the capital. It's the middle of the distribution. You're not getting the top stuff. You're not getting the bad stuff. But that's a different number than the pooled results. And the pooled results are the one that gets stuck in these materials for the trustees that get cited. And again, the stuff from Cambridge comes out because Cambridge has access to that. The stuff from Burgess comes out because they have it. But all the other advisors have to use some of those, or they use State Street. But they have to use things where they don't necessarily have the same access. They don't have the same granularity. They just get some of those numbers, and then they, whether they're an investment, big bank that's selling a big set of private investments, or whether they're another consulting firm trying to sort of upgrade the plan of a pension or a new sovereign wealth fund or something like that. All of these people are using these numbers, and in order to use them, they have to come up, is it 1%, 2%, 3%? What's our premium? And then talk to the trustees who then say, I think 3% sounds good and it has some more risk. Okay, fine, we're ready to do that. But if in fact the average return is about the same but more risky, how do you know that?
That's great food for thought. And I think we're all out of time. I think we're going to have to do this again, Eric, because there's so much to talk about. It's been fascinating. Thank you so much for your time. I think my channel viewers are going to love this. So I think with that we can call it a wrap. So from me, Gavin Ryan, it's thank you very much and goodbye. And from you, Eric.
Yep. No, thanks for having me. And again, I hope it's useful for some folks. And look forward to doing a follow-up on some of the other things that may come up.
Okay. Goodbye.
Good to see you, Gavin. Thanks again for doing this for everybody.